Property Investing Insights, your authority on all things property investing, finance and wealth creation with Right Property Group.
Hello and welcome to Property Investing Insights, Client Stories. And this is the podcast where we follow the journeys of our clients to help you understand how over a decade everything falls into place. And today's guest is no stranger to me. In fact, he's one of the people that years ago I took on a car tour to explain how the concept would work. And so welcome, Uday, and thank you for being here.
Thank you very much. Thank you, Victor.
So let's talk to our listeners and let's give them some context in terms of what do you do. Obviously, you're a young 21-year-old. Yes. And so what do you do in a profession and how did we start this journey?
Sure. Thank you for the compliment, by the way. So my name is Uday Shivamurthy. We, like most migrants, wife and I migrated to this country in the early 90s. So I did some full-time studies. I didn't know what I was going to do after that.
Right.
So
you were a typical student then?
Typical student.
Yeah.
So, finished full-time studies and then I think next 14, 15 years, fast forward, full-time work in the IT field.
Mm-hmm.
So I was hardcore IT work. So I would, if I fast forward maybe 15, 20 years of hands-on IT type work. And 2013, if I quickly come from early 90s to 2013, that's when I was working in CBA, Commonwealth Bank, within the IT space. I work in solutions architecture.
Yes.
So solving business problems using technologies.
So you're a real IT person.
Real touch and feel IT person, yes. So, I was in Commonwealth Bank working with a large team of people. And that's when I met this one of a very, very good friend who introduced me to this concept of property investing. And I couldn't even spell it when he introduced me to that.
Yep.
So that's when he introduced me, and basically he was so confident in his approach, and something about what he said just resonated very well with me. It was probably the confidence, the he used some real numbers to talk about things, and he spoke a little bit about your approach as well. That, I should say, that was the starting point in our journey, 2013. And
And so you had no investing experience back then?
Zero.
And this is zero. Yeah.
Zero investing experience. And in fact, my wife is an accountant. So anything to do with numbers is all her. Anything to do with tech, whether it's home or work, is me. So that's how my life revolved around that. And it's been a fantastic journey since 2013. I dare not say I understand property investing, but just to touch the tip of the iceberg, to see some of the strategies that you articulate in your approaches, it's very fascinating. Yeah.
So I remember, we're talking off camera, where you mentioned that I had come out to actually see you. Those were the days, right? So,
I still can't believe it. When I walked into this office, I even mentioned to Mel that 13 years ago, this office did never resemble what it is. There were a handful of people. I knew them by first name. And this Victor Kumar, you came over in 2013 to meet a potential client. I had not even agreed to become a customer of yours, but we had coffee in Don Fraser Avenue in Sydney Olympic Park.
Which unfortunately I had to pay.
You had to pay for the coffee, and I still remember that. And then not just that, it didn't end there. You bought us coffee, and then you offered us to join you on a tour of Campbelltown back in 2013. And so we took up the offer. So wife and I, we joined you in your Chrysler car. So you took us around there. I still remember that. And you showed us the areas that are still housing commission type areas. And you painted your vision in 2013 of how it's going to evolve over time. And I'm very pleased to say that most of our, at least we have 3 decent investments in that area, and it's paid off very, very well.
Yeah. So obviously you had no experience at that time. And if I may mention Hiroli, who is the guy that actually introduced. So he was in their podcast, and we'll put a link in the show notes for his podcast of his journey.
We call him Rolls.
Rolls, yes, that's right. Yeah, I call him with other names, but we'll leave it off camera. So he had pretty much twisted my arm to say, "Come down, have a chat with this guy. He's very indecisive. He does not know what he really wants and what's possible." And that started the journey, right? So to fast forward to today, how many properties are we controlling?
Yeah, started in 2013, $285,000 purchase in Minto. And
Which was a unit.
Which was a unit in Minto. I can't even imagine those numbers back then. But yeah, fast forward to 2026, we've got 11 in our portfolio. Very healthy. All the investments are in a very, very good, healthy state. We did decide to sell just one investment in Eagleby, Queensland, which was very, I think it was not a well thought through decision.
It was an emotional decision. Yeah.
Probably, yeah.
Yeah.
We thought it was giving us grief, came to maintenance.
Yeah.
This is where I said there is no end to learning when it comes to strategizing the portfolio. But even anyway, that sale wasn't a loss for us, so we made a decent profit out of it. So that gave us, in a way, it gave us confidence that the exit strategy for this does actually exist.
Yep.
The exit strategy does exist.
Yeah. So when you started, did you have a clear goal as to what you're trying to achieve?
Absolutely not.
Yeah.
When we met for coffee in Sydney Olympic Park, one of your first questions was, where do you want to go from here? And I was fumbling for answers. Yes. And the only thing I could think of was, I wanna retire at 55 or something like that. I just mumbled something. So that shows that there was no forethought in either cash management or putting out a plan, cash flow, an investment strategy of that sort. So basically, we started with no plan in mind.
It is actually quite a confronting question, right? When someone asks you to mention something that's potentially really intangible, to say, what are you really trying to achieve out of this, right? Because the focus most people have is that I want to buy property, and then they want to jump in and start buying property. Whereas I actually slowed you down and said, okay, no, let's get the foundational knowledge in place. Let's get the concept in place.
I hated you for that, for asking me that question back then. And I have to admit, even today, if you ask me the question, the clarity is there, but it's not 100%.
No, it's not. Yeah. It evolves as life happens, as incidents in the portfolio, at work happens, and as you continue building your knowledge, you're at a position where you can do anything in the portfolio and still be risk-free because of the solid foundation that you've got. And that's also a problem, right? Because then you don't really know what your next move should be, because it becomes so open field that it's not really, you're not able to really tunnel vision it into a goal. Yeah.
Very well said. Yeah, sometimes
I occasionally say good things in the podcast.
You do. Yeah, you do. This was one of them. So yeah, narrowing down on options is very good, because it's just overwhelming, as you said when you started. Even putting 3 options in front suddenly becomes difficult to make a choice, an informed decision.
And we made a strategic decision to start with units, right? And I wanted to really use this opportunity to dispel the big myths that are being thrown out there following data to say units do not go up in price at the same rate. Potentially true. But it served a purpose where it was very risk-free. We didn't have a whole lot of equity, and we were dipping our toes in the market, right? So we made it as risk-free as possible, and we've bought that for 208. Do you know what the recent sales are in that complex?
Yeah, the agents keep calling me and they keep quoting. So it's more than doubled, of course, the unit prices. And I also want to add to what you said. All our unit purchases pricing has been under 400K. So any unit that we added to the portfolio has never exceeded, I can even say has never exceeded 350K. And
Yeah. So now if you bring it 13 years later, obviously the 200K, our entry price would be 450 to 650 for the same units. Yeah. And this is where, when you, as a listener, when you watching us or listening, maybe in your car, maybe while you watching over the kids, that it's always awe-inspiring to look back 10 years and say, okay, that was what the price was. Wish I'd started then, right? And if you don't get started now, 10 years later, you're going to say exactly the same thing. Wish I'd done it 10 years ago. Because prices in well-selected areas continually move up because the cost of construction doesn't go down. The demand doesn't go down because we're buying primarily in owner-occupied areas, not investor-driven areas. And then the other thing is that time, with its compounding effect, creates that value, right? So as we have inflation, when we have a portfolio, inflation actually becomes your friend because it forces the growth up, right? Yes, the other edge of that sword, of course, is the holding cost increases with inflation, right? So yeah, so we can't have a good growth spurt without having good inflation. Yeah, and unfortunately, with what we try and do to calm down the property market in itself, is that we need to calm down the inflation, right? So that's something that happens that we tend to understand years later. But back then, 208,000, what was the rent on it?
good question. When we started, it was maybe mid 200s.
I think you're overcooking it. It was 180, 185 from memory.
Right.
Yeah, which then pushed up to
450 now.
450 now. Yeah.
Yeah.
So that's a huge increase in
In
rent. right?
rental
So
return.
if you look at it today, in today's dollars, a 208K exposure, and you're getting 450 rent coming in, it's pretty much looking after itself, right?
Oh,
But it's taken you 10 years to get to that point, right? It wasn't looking after itself in the beginning. Yeah. So you had that one unit, and what was your next move, and how quickly was the next move?
Yeah. So between 13 and 2020, or I can even say, confidently say, between 13 and 17, we added the maximum number of properties. I think that was a combination of working. I think our working relationship was pretty solid back then. So it was, and our borrowing capacity was there. There were things, a lot of things in our favor, and somehow we were aggressive in our approach, and you were supporting that. So we went from 1 to 6 acquisitions in from 2013 to 17. We 6 purchases. That's been the busiest, the most aggressive period in the 13 year.
Yeah, yes. And then I did actually slow you down after that.
You
right?
deliberately slowed
Yeah.
us down. I remember. Yeah.
Mm.
I couldn't understand why you were doing that, but now I think I do. Yes, yeah, you slowed us down, and yeah, a few more things kicked in, which is this thing called serviceability.
Mhm.
Yeah,
Mm.
so
Dirty little word.
yes,
Yeah.
yes, yes.
And so obviously, looking at it from process point of view, when lending is easy, you need to go hard, right? Because you will hit that cap very quickly, and then you need to let the portfolio mature. You need to let it give you the lessons it needs to give you, so that it prepares you for the next onslaught of acquisitions. Because we didn't transition the portfolio from units to houses, right? So we had units, and then we started buying houses as well, and that also became a choke point because instead of spending 200, 300, we all of a sudden spending a lot more.
550.
Yeah.
Yes,
Which, pretty much you're doubling the purchase price.
acquisition
Yeah.
price. Yeah.
And so how were you able to handle that mental shift?
Aha, yes. So this is where I love to use your Holy Trinity acronym that you gave me, the phrase you gave me, which is the trinity between the buyer's agent or the strategist, which is you, the accountant, and the mortgage broker. So if not for these 3 people, we would have struggled along our journey. we made a start somehow by hook or crook, and then you constantly fed strategy into my head, and so that kept me going. But without this triangle working, you know, uh, in sync, these things wouldn't have happened. So as soon as you, for example, if I quote Seddon Place, Campbelltown, that was a 2020 acquisition, COVID period. I don't know whether to say it was low demand back then, or whether it was demand was peaking because people were at home and were looking to buy. But either way, we were looking at acquisition price of 570, and you managed to bring it down for us by negotiating with the vendor. But that for us was a big jump. So your question was, how did we do that? So to us, the bank was our PPOR, principal place of residence. That turned out to be the spinal cord. So we were hesitant because we didn't quite comprehend what it meant to use the primary home as a collateral or equity. We thought it's really bad to do that until we got the education from you and the mortgage broker. She's fantastic, the one we got. So using the principal place of residence as equity, and also a couple of units that you helped us buy in Wollongong, that gave us almost 41K plus 30,000 equity we were able to draw from that, and principal place. With that, getting the 20% deposit suddenly just became a walk in the park.
Yes. Yeah. And you've touched on a point over here, right? So you're pulling out equity from the properties because you hadn't actually started with a big financial base in terms of equity position, right? So, which was one of the reasons why we segued into units first, to limit the exposure, because we were not playing with big deposits, right? And so one of the things I find today with a lot of people, when they're starting the journey, they're always focusing on houses and houses and houses, but they don't have the financial capability to buy at the price to buy within the owner-occupied areas in the metropolitan areas. Then they're relegated to either investor-driven areas or into regional areas, which you're probably better off buying a townhouse, a unit, or a very well-placed villa in owner-occupied metropolitan areas, because then it has a greater chance of the doubling effect within the decade. Right now, no one can predict the future. Yeah, it pretty much, my crystal ball's the same as yours. We bought it from Kmart. And it's just that mine's used a little bit more, so I can see more cracks in it and interpret it a different way. Yeah, but it's anyone that's saying that property will double in price and all that sort of stuff in this time frame, I think really they're feeding you something. Yeah, and it starts with B and ends with S. And so yes, a very technical term in this podcast. So when we have that play, the idea, and which is your journey, is that we want to be getting in as quickly as we can at the best quality that we can in the market, because then that sets the foundation. We had those units. Now we've gone into Seddon Place in Campbelltown, which was a granny flat site, and over the years we've progressively picked up the houses next to it and all that. So eventually we'll come back and do something with it.
Yes.
I know I've been hassling you to build a granny flat to bring down your negative cash flow and get into the consolidation phase of paying all of these things off so that you can then ride off into the sunset.
Yeah.
But you haven't found your horse yet.
That's correct. Yes. Sunsets are happening, but the horse is not ready.
Right. So long as it doesn't bolt, we are fine. Yeah. And so we bought that. And then what was the next acquisition after that? So right now, all of your properties are in New South Wales. Yep. Or was there interstate properties as well?
No, in between. The other thing you got me on is, which we never thought of, was both of us, wife and I, used to work full time. So we had a reasonable super contribution. So you put us on this SMSF journey. So that took us a few months to understand the concept, and then to set up the structures. Once we set it all up, then we utilize the funds inside the SMSF to start acquiring properties through the SMSF as a vehicle. That's when we ventured out into South Australia for the first time and into Southeast Queensland.
Yep.
Yeah, those were units, again, we acquired. But after the home purchase in Campbelltown, before her home purchase in Campbelltown was Browns Plains, Queensland. Yeah, so that was an absolute charm in our portfolio. The crown jewel in our portfolio is the Browns Plains.
Yep. And so what's the plan with that property and what are the numbers on it?
Yeah. So the purchase price again for a freestanding property, 700 square meters, 570 square meters, sorry. Freestanding Southeast Queensland, Logan County was around 570. And it's the value has come close to double right now as we speak. So the plan is we're working closely with a builder you recommended, who's put a plan together, and we're in the final stages of getting the construction loan approved because we want to drop a granny flat there, a 3-bedroom granny flat. Yeah, in terms of rental returns, it's absolutely a killer.
So what's it rented for at the moment?
Right now is I struggle with the numbers. You always do this to me.
So it should have a high 5s, early 6s on it, right?
Easily.
Yeah. So and with a granny flat, have you got a cost estimate of how much? Yeah.
So we're looking at a proper brick veneer type construction. So
it's not a shed.
No, it's not even one of those fabricated homes. So we're looking at close to between 270 and 300K construction with a carport only, not a garage.
Not a garage, yeah. So that'll rent easily for 600 as well, right? So if you look at it, your expenditure is circa 300, and your rent coming in would be 600. And then you've got the added benefit now, provided by the time this podcast goes out, they haven't changed negative gearing laws. You've got the depreciation of that coming in as well, right? Which is further giving you further cash flow. And there is still money tax-wise in older properties, provided you materialize the full strategy to get back to that position, right? So, and so you're in the final throes of pulling the trigger on that.
Yeah. I just wanted to mention that as time goes by, the borrowing capacity tends to become difficult. And the reasoning for that is the serviceability calculator takes many things into account, including the investor's age and earning potential.
A Scotch bill as well.
Yes, for sure.
Yeah.
And my Bentleys as well.
Yeah. Oh, touche. Yeah. So with Browns Plains, let's stay with that for a moment. Yeah. Take me through the process, because there was some admin work we had to do to be in a position where we'd be build ready, right? So I'm talking more in terms of the leases and how you had to realign the leases on Browns Plains to be able to have the opportunity to build on it, right? Because one of the things we did was put in a clause there in the lease when we renewed it to actually allow you to build.
Yes, exactly right. So yeah, when it came to renewal, we are very fortunate. We have an excellent property manager. We didn't touch on that topic, dealing with property managers. So with Browns Plains, we have a very proactive property manager. So all I had to do was pick up the phone and let her know that this is the plan. It could happen in 6, 12, 18 months. Don't know, but you do what's required so that I don't want to lose the tenant at any cost. The tenant's fantastic. We had no issues with him. So do what you need to do so to keep the tenant happy and make sure we are compliant. So we had to lodge, I think we had to lodge something to inform the tenant formally and to get like a no objection from the tenant. And from that point onwards, the builder is ready, literally ready. He has plenty of capacity to take us on. So yeah, as soon as the drawdown is complete, we will pull the trigger.
Yeah. So that's getting into the advanced stage of portfolio where you're coming back with rather than buying something else, we're now coming back and working within the portfolio, which is one of the conversations we had, right? I remember last year you called me and said, I'm ready to buy again. I said, oh, I don't think you are. We need to go back and fix these things first.
Yeah. That got me
before
thinking. Yeah. That's what put me on to Set in Place first or Browns Plains,
Yeah.
because these are the only two that have potential
Yes.
for us to do something with it.
Yeah. And what made helped you with the decision to go with Browns Plains as opposed to Set in Place?
Yeah, Set in Place. It's I think there is a bigger strategy in place wherein RPG has more clients, is what you told me, in the neighborhood. So the long-term thinking is for some of us to get together and see if we could do a larger development. Yeah.
Yeah.
So,
And speaking of larger developments, we then tacked back into a unit.
yeah.
Which is the Warby Street units.
Oh, yes.
So,
Yes.
so this is
Good
where
timing.
we had a strategic buy-in in a group of townhouses in again Campbelltown, and I've done this concept in all states, where we're going in and buying progressively until we control the whole block. Yeah, and so this was 9 townhouses.
Yes.
You are an owner in there.
Yeah.
And this is something we haven't flagged with all of the owners right now, but we are about to go into council. We've already got a meeting lined up and paid for the meeting to go and do a pre-DA.
Easy.
Plan being that we will do a high-rise over there, right? So again, that's an example of a generational property where we would take the risk or not take the risk. It will depend on all of the 9 owners. So majority would count. So you've now got, if you look at your portfolio, you've got your simple, doesn't keep you up at night and doesn't break any records, but does consistent stuff in the background units. Then you've graduated to houses. Then we've circled back into a generational property, being the Warby Street ones. And now we've gone all the way back to the properties we could work on. And we're building secondary dwellings there to further enhance the income coming in. Yeah. And so as we do this, has there been any further thought between you and your wife, conversations in terms of, okay, how do we get to the end stage of this portfolio, or is it still fuzzy at this stage?
Yeah, I'd like to say it's a little fuzzy at this stage. Yeah, because we have to work out what consolidation actually means to us at this point in our life. Yeah, and a few milestones we have to set within our own personal lives. And once we've completed those things, then we'll probably circle back to you to see the Trinity, you the accountant, and the broker.
Just remember, I'm on the top. I'm the Godhead. Yeah, and the rest.
So it's not a Trinity. It's 4 edges.
Yeah. So that is a natural progression, right? Because when you get to that stage where you get addicted to the purchasing side of things, yeah, and you mistake progress with purchasing as opposed to working with the portfolio.
Well said. Three P's there.
Yeah.
Progress, purchase, portfolio.
That's it. Yeah. And so when you're at that stage, also you come to a point to say, you know what, I'm going to continue working, right? And I might buy the opportunistic property here, or I might sell down at some point in time, or I might just turn things into principal and interest and let it pay it down, right? So there's no real set way of getting there. Yes. Apart from, there's only 3-4 ways actually to pay off your loans: surplus PAYG income, surplus portfolio income, so then building the granny flat, right? So you get surplus income there and turn that loan into principal and interest. Yeah. Or you sell something, right? Where you could sell down some of the units to pay out the other houses or units. The 4th way, of course, is you start playing lotto, and maybe you win.
I like that.
Yeah,
that's
probably the surest way to win, right? To pay off
so.
a portfolio.
I think we should bake that into the strategy. Cornerstone there.
Give the money to me. I'll buy the ticket.
For sure.
Yep. So now, as you went through this journey, right, there was some life lessons. the biggest one, and you touched on this in terms of Eagleby, right? The biggest Eagleby, yeah. The biggest one was maintenance and repairs, right? So when you got your first lot of repairs and large repairs, what was the thought process and how did you handle that?
That's very easy. As soon as I got the call from the property manager, I was on a call with you.
I had you blocked most of the time. Yes.
It was so simple. So I basically transferred the problem to you. I'm joking, but no, like I said, the learning never ends here. There are so many facets to this whole journey, property investing journey, and one of the facets is how do you deal with maintenance bills that keep popping up across 11 properties. I dare not say it's even not had a pause. Pretty much every other month there is a maintenance issue. Yeah. In terms of big ones, the major ones that came up, what the strata deems as capital expenses. Yeah. So that's where the guidance from you was fortunately, we had more Right Property Group clients in the same block. So we had, I won't say leverage, but we were able to put our thoughts on the table. Yeah, yeah. And then we agreed on, we were part of the decision making. For example, in Wollongong, the entire roof for all the 5 units had to be ripped out and we had to do the re-roofing. So we were part of the journey, and this was fantastic for me from a learning point of view. Worked closely with the strata, with the builders, with the people quoting. We had a say in picking the right offer, and we went ahead with it. So it's all a case of pitching into the sinking fund and making sure the fund is in a healthy state. And since that, in Wollongong, we never had to address any major issues. But then it shifted to Charlestown in Newcastle, where we had to do some major stormwater drain type work. And all the concreting had suddenly disappeared with the storm. We couldn't find the concrete slabs anymore. They had all run away. So these things keep coming up. And once I got into the flow and understood how I need to work with the strata bodies and get the appropriate advice at the right time from the accountant and yourself, it wasn't hard.
Yeah. And this is part and parcel of owning a portfolio, where if you're actually buying a dynamic portfolio that'll actually get you the results, there is always maintenance, right? Everything has got a use by date. Waterproofing could fail, bathrooms need to be replaced, kitchens need to be replaced, roofs, particularly with the way the weather is turning, they need to be replaced. So it is part and parcel, and we just need to understand what things generally cost, so you're not getting a absolute premium in terms of the quotes that you get, so that you are then guiding the property manager, right? Because you very quickly learned that you need to manage the property manager so they can manage the property. Yeah. And you mentioned the good property manager in Queensland. That was a good example of it. So have you had any issues with property managers that you, when you look back and say, okay, they haven't done the right job, or they could have done better?
Yeah, I won't mention names in the podcast, but yes, that did happen. And it came to a point where I had to approach other Right Property Group clients. Of course, I went through you, approached them and asked them whom they've appointed as the property manager for the same block. And I had to pull myself out, and that became difficult because the property manager, I had signed a clause where they forced me to stay for 3 months with them, even though it was a performance related issue and it's almost a complaint. They said I have to stay with them even though I'm unhappy. So that's how it happened. Again, something I had to deal with. But the good part is the property manager that I was going to was very understanding. So even though he wasn't my property manager, he informally took on certain tasks in that transition period. So that's the importance of being on top of property managers, like you said, managing the property manager.
So what I'm seeing here is that you're always tapping into a community, right? So
It's happening a
yeah,
lot. Yeah.
yeah. So tapping into and this is our process here, that if a client buys a property and they have an issue, that contact the team and they guide them through, because we're all property investors in here, right? So we're able to then give them real life guidance as opposed to textbook guidance. Big difference between the two. Yeah. So and as you build your portfolio, property managers go through their ups and downs as well, right? Some good performing property managers will have some few bad months. They get overstaffed, understaffed. All of those things happen, and it's important to, I find, is to remain civil with them, even if they've done the wrong thing by you, because it comes back to you.
Oh, 100%. Yeah. We can't afford to do that.
Yes.
In this society.
Yeah. So let's go back to Ego B. The maintenance and then also the interest rate ratcheting up
Yes.
caused panic. Yeah, because and the reality is you're carrying a lot of debt.
Yes.
Yep, and when you're coming from 2% and going barreling up to 6%, it plays with mindset.
Yes.
Yeah, even though you had capacity to hold on,
Yeah.
you decided to chop off a problem at the time, and so you put that on the market and sold it. Yeah.
Yeah.
So,
Yeah. Do you want to know the number of people who came for the 28? 28 parties turned up.
yeah, there you go.
Yeah. And apparently they were fighting to buy that. So
But it served its purpose, right? Because it gave you back your sleep at night factor. Yeah. So I've got a simple mantra in terms of property investing is, why are we investing in property? And it is for comfort in life, right? And if comfort in life means we discard one asset, so be it, right? It's given you comfort. It's done its job for what it needed to do in your journey. And now we've also have a life lesson in there. So I sell a lot of properties in my portfolio, right? Where planned and sometimes unplanned as well.
you sell unplanned as well.
Yeah, I do. Unplanned in the sense that someone comes in and gives me a crazy offer. Of course, I'm going to sell. Yeah. So I have a rule that I never then go back and search for that property and see what it's worth next, right? Because it always gives me, it gives me ulcers, because you leave money on the table when you sell down a performing asset. But the reality is that you do need to sell down it sometimes to fund lifestyle, fund projects, pay down the loans. And so high level numbers, how much are we carrying in terms of debt?
I just looked at the LVR after factoring in the Eagleby sale. The LVR is 27. Yeah, 27%. Yeah.
Yeah, I hate you. Yeah.
Thank you. You caused this.
So we started with very high loan to value ratios, right? Because you are a bank employee, you're able to get 90 years.
46 to 48% LVR when we I wouldn't say when we started during the early days.
Yes.
It's now down to 20.
Down to 20, yes. So, but when we borrowed the money, we were going 10% deposits at the time. Well, yep. So.
Just a handful of them. Back then, you were right. Very, very easy money. It was very easy to get. So 10% would suffice for investment loans. Then very quickly it went up to 20%.
20%, yeah, because then you became a risk to the bank because you had more properties than the
very
norm.
quickly. In fact, I hardly remember how many, maybe one or two at the 10% deposit. Then next thing it was 20%. And we weren't struggling, to be honest, to put 20% down. With the strategies that we had in place, we just had to work meticulously to get the 20 and just 20%. That wasn't a showstopper for us.
So what would you change in this journey? If you had a magic wand, we could go back to 2013. I know what I'm going to change.
Okay.
I'll get you to pay for the coffee.
For sure.
Yeah.
For sure.
But from there, what would you change from there to today?
What would I change? Firstly, my risk appetite. I would look introspect because it's the fear of the unknown. I just don't know what I'm afraid of, but I'm just afraid.
Right. Yeah.
So that's a stupid place to be in.
It's like a kid in the dark, right?
Yeah. What am I uncertain about? Well, I don't know what I'm uncertain about, and that makes me more uncertain. So I have to this cycle, it's breaking out of this cycle is very important, not just in investment, but in life as well. I've seen this. But what would I change is, once I recalibrate my risk appetite, uh, if I was to rewind the clock, I would have gone for more freestanding assets. More freestanding assets, because there's more room for me to do things with that.
We can come back and do stuff to it.
Always come
Yeah.
back and do things
Yeah.
to it.
So I look at freestanding homes as the larger rocks in the jar. Yep. And the units are your units, townhouse villas. They are mid-size or smaller rocks. And then, of course, the liquidity factor is the water you pour in to keep everything afloat, right? So,
Love that.
yeah. I just made that up, honestly. And so...
You sure it's water?
it could be scotch. Could be scotch. Yes, could be scotch. Yeah, very good premium quality scotch. Yes. So doing it that way, you're then not stalling your progress. So and being that no house only. You're going in with what makes sense at that point in time. Because one of the things I'm finding in the market right now is if you're getting into a house, you're getting in circa 750 to 900 for a decent home in a decent area. The negative cash flow is anywhere from 20 to 30K. Yeah. So that's a huge hit. Whereas you could...
Is this is this in the owner occupied belt?
Yes. Yeah. Now, investor belt obviously can get cheaper stuff. Yeah. But then you're running into trouble as well when everyone else runs into trouble. So if you have a 900K home, you could, and you aren't able to qualify, or if you're able to qualify but you can't hold on to that 25K negative cash flow, you could hold 2 townhouses a bit closer to town and have perhaps a 15K negative cash flow all up for 2 assets. Yeah. So this is where you need to look at it from not a Puritan sense, but a reality sense, to say, okay, this is the affordability factor. Because what kept you going through was the fact that your portfolio was affordable to you.
Yeah. I would say the most important factor used to be that. If I can digress for a second, I remember when my mom used to be alive, and when she came to know about this journey that I've embarked upon, she almost made fun and laughed and said, "What's all this, buying all these, piecemeal?" She always liked mansions. Whether it's for investment or living, it doesn't matter. So her vision was that I should be investing in mansions. And when she heard I was buying all these units and things, so she almost laughed. And
almost disowned you.
Yeah, 13 years later,
Yeah.
those things have turned out to be the pillars.
It's the selection criteria and of course matching it to your financials.
Yeah. And the sleep at night factor.
Yes.
So there's no point in making that emotional decision just because it feels good. At a certain point, if it felt good and I jump in there, and then my sleep at night factor is compromised.
And our conversations during our reviews have always been around cash flow and when to stage and when to sequence the next acquisition, to the point where as the portfolio became a little bit top heavy, I was slowing you right down and pushing back on you to say, no, we're not buying this here. Yeah. And,
I remember many of those conversations. Yeah.
Yeah. And this is where, life in the forefront, investing in the background, right? So that's what needs to happen. So we could continue talking about this forever, right? Because this is a journey that we've gone through together. You've made the decisions. I've given the guidance. If you were to give a advice to someone that's just starting out today with today's color of property investing, what advice would you give them?
I would say have this network, very, very important. Have a strategist who thinks on your behalf. Don't be shy. If you don't have a strategy in place, don't be shy to admit that you don't have one in place. And precious to have an accountant who's not just good with numbers, but a solid strategist as well. I keep using this word. And the last one is a mortgage broker who looks after you. Again, who's a strategist. I keep saying this because none of this is short term. Yeah. So that's even though someone's starting out now, they have to step out of their comfort zone and think in a little bit long term.
Not immediate wins, right? So longer term wins.
Yeah, stock market would be better for that, day trading or stock market.
Yeah, absolutely. So that is strategy by design. This is Property Investing Insights. Uday, thank you very much for sharing your story with us.
It's been a pleasure.
I hope that you've got immense value out of it. Don't be a stranger. Share our podcasts with your network. And if you wanted to talk with us, we are just an email away, or go into our websites, rightpropertygroup.com.au, and hit the contact me form, and we will be in touch. Until next time, goodbye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.